What's up everyone, it's Karthik with MoneyVest. I'm recording this video before the markets have closed because I'm trying to go to bed a little bit earlier today because we've got the Tesla robo-taxi event happening in now less than 7 hours. So it's like 1 a.m. in the morning right now. I usually record these updates at 2 in the morning. So again, if you guys appreciate these updates and of course find them helpful, make sure that you drop a like and subscribe to this channel if you haven't already. And please do me a favor and share these videos with your friends and family members, other traders, investors that can benefit from these types of updates on the markets. And again, I'm staying up pretty late at night to bring these updates to you guys. So I would really appreciate that recommendation. That word of mouth is really what helps us grow our channel, and we're almost up to 85,000 subscribers. So first things first, markets right now are pulling back just slightly on the back of the very important inflation numbers that came out earlier in the day. So we were live to break down the CPI numbers, and as of the time of this recording, the Dow Jones is down over 111 points. We've got the S&P 500 down about 30 basis points on the day, and the NASDAQ is essentially flat, down about 16 basis points. We were green, we were higher at one point, up over 15-20 basis points, but then of course circled back lower, and we're really just trading a lot sideways. We're just seeing a lot of consolidation for the markets at the moment. Now, I took a trade on Celsius. I sold some puts, and we are now currently up over 46% on those puts. And not to mention, I actually shared a trade idea yesterday because my cash not cleared yet. So I mentioned in the options channel that my deposit hasn't cleared yet, so I can't sell puts right now due to the lack of collateral because it wasn't cleared by my broker. But I do like the CELH, which is Celsius cash secured puts here at $26, $27 strikes for next Friday, 10/18. Good premiums, 20 to 30 cents per contract, and that's 0.8 to 1% return on collateral in just a matter of about 5 to 6 trading days. I take that trade if my cash was cleared, most likely tomorrow, but sharing this idea today. So a lot of our members ended up taking that trade yesterday. They were up over 80 to 90% because if you come take a look at how Celsius is trading on the day today, it is up a little bit over 13%. So a very, very massive move to the upside, getting back over $34. And of course, I ended up selling puts today, which are now already up over 46%. So if you want to get access to all the trade alerts, find out exactly what I'm trading on a day-to-day basis. Again, our focus is very much on quality over quantity. I'm not going to be sharing a lot of trade ideas, but when I do, you better believe it, the probability of success is going to be much higher because I'm doing all the legwork, all the research, all the due diligence for you guys to bring the best of the best ideas for you. So again, you can make a decision whether to trade that or not. And of course, I do have the Tesla position in the options portfolio going into this very, very important day, which is going to be the Tesla robotaxi event starting in just about 6 to 7 hours, for which I will be live. So I'm going to get some sleep after this market update and then wake up early in the morning to cover the 10 p.m. Eastern, 7 p.m. Pacific robotaxi event, which is called We Robot. More on that later. Now, this right here is how the markets are trading right now. Energy is once again getting a little bit of that momentum. We're going to get to inflation in just a minute, but energy is the sector leading this market higher today, up almost 1%, with basic materials of 44 basis points. Everything else is selling off. Real estate, industrials, consumer defensive, all these sectors starting to roll over just a little bit. In the last 1 week, though, of course, technology has really led this market higher, as I've also shown you guys in this relative rotation graph and how we are seeing a lot of rotation into technology. So if you come over, take a look at the last 6 to 7 weeks worth of tails, you'll notice that real estate and utilities are the ones that are moving from a leading quadrant down to a weakening quadrant. But XLK, which is right over there, is going from weakening to lagging to now rotating back more towards improving. And of course, communication services and discretionary is already from improving going into leading quadrant as well. And then financials and staples are also moving downwards, coming down to a sort of like a weakening quadrant as well. So those are some things to obviously keep in mind. We're seeing oil prices also recover back higher. So if you come over to this right here, crude oil, we're seeing crude oil, of course, up on the day, up over 3.5%. So back up to almost $76. And as a result, pretty much the entire energy watch list is green. Marathon Petroleum, Occidental, ExxonMobil, Chevron, everything is higher. BP, XLE, Shell, everything pushing higher in the green right now. So if you come over to our market concentration, you'll notice the markets, of course, are down by $168 billion. But if you specifically look for energy, which again, you can do that on our MoneyVest platform, which by the way, you can get access through our Patreon. It's just 29 bucks a month and you'll get access to the entire website and you can utilize it and you can do your full fundamental analysis. But this right here is energy stocks within the S&P 500, 22 stocks up over 1% collectively, over $17 billion, a lot of liquidity flooding into ExxonMobil, Chevron up over 5 to as much as $2 billion respectively. Again, Schlumberger, a lot of these companies are pushing higher really, really well. So that's where we're seeing the money rotate into. And moving forward, there's a couple things that I really want to break down. The first one's going to be the CPI, that's the inflation numbers. And the second thing is the deficits, the actual national debt and the deficit. And we're seeing the yields actually move higher as well. The 10-year treasuries back over 4%. We actually had a couple bond auctions, the 10-year and the 30-year. And of course, the awarded yield is much higher than what we witnessed previously. So first things first, let's talk about inflation, right? So coming over to our calendar, if you come over to our economic calendar, and if I remove for low and medium impact items, you'll notice that this right here was today. This is Thursday, 10/10, that's October 10th. Core CPI came in month over month at 0.3%. This was higher than what the expectations were at 0.2. So a little bit hotter than expectations on core CPI. Year over year for core CPI also coming in worse than what the expectations were and also ticking higher. So it actually went from 3.2 to 3.3%. So that was the actual number on a year over year basis for core inflation. If you look at headline inflation, which is the actual CPI, 0.2% increase month over month, also coming in hotter than what the expectations were. And then year over year coming in at 2.4% versus the expectations of 2.3. So even though we are coming down from the previous number of 2.5, it came down to 2.4. So yes, we made some progress on headline inflation thanks to energy, because energy was down significantly on a month-over-month basis. However, that picture could change going into the November print for CPI, which is going to be for the previous month, October, because October so far energy prices are higher. The really concerning piece here is core CPI. And if you come over to some of the items, such as right over here, and this right now we're looking at headline inflation. So this is all items inflation, of course, coming down to 2.4 as mentioned in our website. But if you come take a look at all items as food and energy, right? So if I exclude for food and energy, aka the core CPI, this right here is what is really concerning, right? The fact that we're ticking back up from 3.2 to 3.3% is really what's concerning a lot of people. And if you really kind of drill down in that report, you'll notice a couple of different things that I really want to highlight: transportation services, apparel prices, shelter. These are the items that are non-headline inflation, non-core items, right? So these are the items that are part of both headline and core CPI. Because if you really take out energy and food was also up quite a bit actually. So it was up 0.4% on a month over month basis. Annualized, that's almost 5%. But again, if you take out food and energy from core CPI, what are the items that are really affecting core? And that is apparel, up over 1.1%. Transportation services, airline fares to be precise, were up over 3% on a month-over-month basis. And then, of course, shelter, 0.2%. That is actually a lower growth rate, the lowest we've seen since June of 24, but still affecting a third of inflation. Of course, the fact that it's going up and it's up almost 5% on a year-over-year basis is certainly still concerning from a core CPI standpoint. Now, the bad news is that energy so far has been really beneficial to inflation. In other words, it's actually been helping the Fed. It's been doing the Fed's job as oil prices have come down. We are now in full-blown deflation for energy. And that you can see that on the charts here. So if I remove for this and if I only bring up energy, you'll notice how low it is. It's actually below the 0% line. And you can't see it right now. Let me just zoom in a little bit. Negative 6.8% is where we are for energy, meaning that prices are indeed going down for energy. You can see that at the pump, right? So the gas prices at the pump are probably lower from same time last year, thanks to prices coming down, oil prices coming down. And as a result, it's been helping headline inflation. So if I plug in headline inflation, you'll notice you can't really see because of the the differential here. But if I remove for energy, you'll notice that it's been coming down thanks to energy prices coming down. Now that's the bad news, because if energy prices start rolling up again, if they start going up again because of the fact that there's a war over in the Middle East, and of course there's production cuts, and in the month of October so far we're up a little bit over 11%, folks. We're up 11% in the month of October. And if energy is no longer in deflation, shelter prices stabilize around 4.95% year over year. Food prices were up on an annualized basis almost 5%, not to mention transportation services, airline fares, and apparel and used cars and some of the other items. Then what we have is a big problem related to inflation resurging back to the upside. So that again is a bit of a problem. Of course, we did also have the jobless claims numbers. So if I move for medium impact items, initial jobless claims coming in 258,000 today at 8:30 a.m. Eastern, which was also hotter than what the expectations were of 230,000. And if you come down and take a look at some of the bond auctions, the 30-year bond auction came in at 4.389%, higher than the 4% yield awarded in the previous auction. And yesterday, we also had the 10-year note auction sitting at just over 4%. That's 40 basis points higher than what we were awarded previously. So yields are pushing up. Inflation is also coming in hotter than what the expectations were. Initial jobless claims are also moving higher. So the big problem for the Fed now is going to be a potential nightmare. Again, this is not supposed to be scaring anybody. At the end of the day, we already know that these are all going to be buying opportunities for us, because most of these problems are going to be indeed temporary in nature. So that's going to be buying opportunities for us. But I really want you all to be aware of what could potentially be on the horizon if, for any reason, we see inflation reaccelerating back up. And of course, not to mention unemployment also starts moving up. So the Fed's worst nightmare has begun. The core CPI rises to 3.3%, the first increase since March of 23. 258,000 people filed for unemployment this week. Expectations 230,000. So both of these indicator I showed you guys on our website. You can pretty much track this on the economic calendar at moneyvest.com. And once the September jobs report is revised sharply lower, it will reveal the Fed's nightmare situation, which is rising inflation with rising unemployment. And that is true. That is the worst case scenario. So we've also got 4 quadrants over here. We got 1, we got 2, we got 3, and we've got 4. And this is the Fed's dual mandate. This is the dual mandate bullseye. And this is where the Federal Reserve wants to operate. This is literally where they want to be. They want inflation at 2%, core inflation. So that's core inflation right there at 2%. And they want unemployment at just a little bit over 4%. So that's where they want unemployment to be. So where we have unemployment right now, 4.2. So that's right well within the target of the Fed. Where do we have inflation? We've got inflation well over 3.2%. If you're measuring it by core CPI, we've got inflation at 3.2. So if I really tell you where we are at the moment, we are somewhere over here. And this is an exercise that we have done before on the channel. We're right about there. Actually, we're right about there. So this is where we are, because we are at 4.2 on unemployment. So on the x-axis, we are right about there. And on the y-axis, we're all the way up here because we're at 3.2% inflation. Now, there's a lot of different trajectories for this particular dot. This is why it's so important to keep track of where this dot goes. Now, we can move in the second quadrant. That's the worst case scenario. That's the nightmare situation for the Fed. We can move in the first quadrant. We can move in the fourth quadrant, or we can move down in the third quadrant, or we can move down to the bullseye. That would be the ideal scenario, right? That would be bringing inflation down while keeping unemployment steady and where it is. A little bit more difficult to do when you've got rates as high as they were. Of course, the economy continued to be very strong, so we didn't really see the effects of higher interest rates on the economy. Somehow it continued to grow at a very nice pace with very low levels of unemployment. Now we're starting to see rates come down as much as 50 basis points. And of course, the markets are still pricing in for another 50 basis points in the next couple of meetings, November and December. And the big question now has become, is inflation going to go higher? So in other words, there's another place inflation can go, and that is higher. So that is meaning that it's going to be above the chart. It's going to be above this picture. And that, of course, will be the worst case scenario because the worst case scenario really is going to be moving to the top right, going right there, because it's anywhere in the second quadrant is the worst place to be for the Fed, because then you're essentially higher on both inflation and unemployment. and then it's going to be contradicting their own dual mandate, whether to raise rates, lower rates, keep them where they are, what to focus on, stimulating the economy so that unemployment can come down, or raising interest rates so that inflation can come down. So that's going to be the big question for the Federal Reserve. Something to keep in mind, because that's going to be very important as time goes on. And of course, if inflation starts to accelerate back up, that's only going to make the situation worse, because then the Federal Reserve will eventually be forced to pivot back to a quantitative tightening monetary policy stance moving forward. So that is not what the markets want to see. That's not what the markets want. So just want to be very clear. These are the 4 different quadrants where we could potentially end up. So let me know in the comment section down below, where do you see the markets going in the future? Now, we got another problem to deal with, which is the US deficits now reaching over $1.8 trillion in 2024, $139 billion higher than fiscal year 23, and $400 billion higher than the level seen in 2022. That's from the Congressional Budget Office, data released Tuesday. That's the CBO in the US. That's a government agency that tracks the budgets and the Treasury Department. And the largest outlays were Social Security, debt interest payments, and Medicare at $1.5 trillion, $950 billion, and $869 billion respectively. So if you come take a look at some of these charts, which is definitely very crazy, $1.8 billion worth of deficits in 2024, of which interest payments alone make up for almost $1 trillion. That is absolutely insane. And if you've got rising deficits with a rising interest rate environment, that's also not good. So David Summers essentially tweeted, yes, a rising debt along with a US Treasury bond yield curve mostly at 4% or greater means that the interest expense will continue to explode higher, making the entire deficit problem even more difficult to solve. As you can see, that interest payments have absolutely exploded in this higher interest rate environment. They've gone from about $400 billion to now almost sitting at $1 trillion worth of interest payments for the debt for the US government. These are more longer term problems, but definitely worth noting where we are with the current balance sheet of the United States government. Now, moving gears here, shifting gears and coming over to the earnings expectations. So third quarter earnings is just about getting started. So if you come over to our website and you switch between economic and earnings calendar, we had a couple companies report. Delta, Domino's, Pepsi already reported their third quarter numbers, but the real earnings season is going to start tomorrow, so Friday, October 11th, where with the big banks reporting first: JP Morgan, Wells Fargo, BlackRock. And then of course next week we've got a lot of companies scheduled to report, including Bank of America, Goldman Sachs, Citigroup. We've got Netflix, Morgan Stanley, Abbott Laboratories, Johnson & Johnson, American Express. So there's going to be a lot of companies getting started with reporting their earnings. And third quarter numbers, both Max 7 and other 493 companies' earnings are expected to slow down in the third quarter. This is as of Bank of America's expectations. And this right here is the growth rate expected to be one of the slowest growth rates since the declines we witnessed in 2022. So these, of course, were the quarterly declines, even though we didn't quite go into a recession, not a technical recession or not an economic recession, but we did go into an earnings recession. I want to be very clear, because we actually did see 2 consecutive quarters of GDP decline, earnings decline. So over here, if I point that out for you, you see those 2 really light blue bars coming down. That's 2 consecutive quarters of earnings declines for the S&P 500, and that itself is a earnings recession. But of course, very quickly we exploded back up to the upside for earnings, moving forward. And of course, right now we're expected to see that number to slow down as well. If that number turns negative, then of course we've got another earnings problems on our hands as well. Now, this right here is what Elon Musk tweeted tonight, which is the future will be streamed live, and that is going to be on 10:10. So today at 7 p.m. Pacific, 10 p.m. Eastern. And this right here is where we are with the MoneyVest index sitting at just over 3.8. So not a lot of change considering the markets are essentially flat, slightly down from yesterday. VIX is just flirting above 21. Again, contango level is still in backwardation, well over 7%. And again, majority of stocks trading back above their moving averages still, after, of course, this nice recovery back to all-time highs from the S&P 500. A couple of different things I want to mention is if you take a look at the global PMI, we're still in contraction territory at 48.8. US jobs numbers, of course, 254,000 jobs added in the month of September. Consumer spending down to 0.2%. And US personal consumption expenditure, so PCE, which again is the Fed's preferred measure of inflation, and core PCE is going to be a little bit different, but headline PCE down to 2.2%, which is again closer to the Fed's target. However, core PCE is still above the Fed's target. So coming over to the markets now, we are going to close in about a couple minutes here. Oil prices, as we already discussed, back up to almost $76 per barrel, and the next target is going to be $80, $81 a barrel. If there's more escalations, things get worse between Israel and Iran, then of course we can expect oil prices to move back higher, which indeed is going to be affecting inflation for our future reports. Volatility is slightly coming back down, but flirting just over 20 right now. We kind of hit a high of 23, and then of course 3 back-to-back red days for the VIX right now. And then coming over to the market breadth, again, got a little bit of a bounce back higher for percentage of stocks trading above their 20 SMA, back over 57%. And this right here, percentage of stocks trading above their 50 and 200 simple moving average, still pretty elevated, I would say 71 to 75% respectively right now. Coming over to S&P 500 and the NASDAQ, so CAEL8, Celsius up over 14%, doing really well. S&P 500 is down just about 18 basis points right now, with about a couple minutes left for market close. A little bit of a doji candle, so a lot of indecision on the back of this CPI report, which I would characterize the CPI numbers to be not hot, but concerning. That's it. So it wasn't a great report, obviously, because we came in hotter than what the expectations were, but it wasn't crazy bad either. Yes, it was just a little bit of an uptick in core inflation, but one report does not make a trend. So for those reasons, I think it's really important to be more cautious and just understand that one report does not make a trend, and that could just trickle back down. However, we have to keep a close eye on oil prices, because oil really is going to hold the key to everything else. Transportation services, airlines, fares, shelter to some extent, food, transportation services for food. A lot of things are going to be affected by oil prices, prices of gas at the pump. So that's really what's going to be the main topic of discussion moving forward. So S&P 500, a little bit of a doji candle. Support level stays put at 56.65, down to as low as 55.20, down to as low as 5400. Those are the 3 levels that I've already identified for S&P 500. Of course, we do have PPI numbers coming out tomorrow. Coming over to the NASDAQ, so continues to trade inside this uptrend, so higher highs and higher lows. This right here, again, is going to be that target up to 18,450, and support level right here at 17,800 for the NASDAQ as well. Moving over to some individual stocks, starting with Tesla, and Tesla already broke down a little bit on the day. So now the markets are closed at 238.75, down almost 1% on the day here. However, somehow managed to trade back above 234. So there was buyers that stepped in right about here at that area of support. And of course, we'll find out how Tesla trades after the Robotaxi 1010 event. However, I want to be very clear, expectations are sky high, and I'm not super confident in how Tesla may end up trading after the event. My gut tells me that it's buy the rumor, sell the news type situation, and would not be surprising to me if Tesla breaks down below 234 and kind of makes its way down to 225. That's going to be that next support level to watch for Tesla. And of course, the resistance stays put at $250 for the company as well. Starting with Apple, and Apple, of course, has been consolidating sideways for quite a few weeks here. So this is the lower high and the higher low coming in. Very similar to what we have on the NASDAQ as well. But that right there is going to be that area of resistance at 232 for Apple. Support level sitting roughly at 225 down to 217 for this stock. Amazon, on the other hand, also coming up to its resistance, up almost 81 basis points on the day. Resistance going to stay put at 190. And of course, that lower high coming in, that's going to be all the way up to 193. Support level, of course, down to 171 for Amazon. Coming over to NVIDIA. There's news that the Blackwell chips are sold out for the next 12 months, according to Morgan Stanley, and they see that the growth is going to accelerate going into 2025 as well. And NVIDIA is very close to all-time highs of 140, or just about $5-6 away from all-time highs, and that is going to be that resistance to keep in mind for NVIDIA. And I am really considering rolling out my options really far out so I can increase my strike price on NVIDIA and get it up to at least 118 or 120. So I will keep everyone posted on what I end up doing with my Nvidia shares. And support level is going to stay put down to 129, 130, down to as low as $113 for Nvidia. Advanced Micro Devices actually had an AI event. I was watching it for a little bit, and then I shared all the updates in our Discord. I shared the actual live stream. Lisa Su was talking about all the advancements and innovations that they're doing in artificial intelligence. However, the stock did not like that at all, down about 4% right now. Initial reactions are almost always negative as the market takes time to digest all the reports and everything that was discussed. I'm sure AMD's got a bright future, moving forward. But valuations, of course, very, very high. And if it does end up selling off further, I would not be surprised to see a support down in the 150s, down to as low as 134 for AMD. So that right there is the higher high and the higher low, getting a little bit of that breakdown on the day. And that next support, like I said, it's going to be 150 for Advanced Micro Devices. Coming over to Meta Platforms, and Meta here continues to consolidate sideways, coming back down about 1% here. Support level is going to be at $581. Resistance stays put at 602. If you do get a little bit of a breakdown below this level, next support and target is going to be 540 for Meta moving forward. Talking about Netflix, and Netflix here continues to break out to new all-time highs. So phenomenal move to the upside. Support level is going to stay put down to $700 per share for Netflix. And after a consolidation sideways, and we're finally seeing a bigger breakout for Netflix. Google, on the other hand, continues to get rejected at that area of resistance. Support level is going to stay put at 153. So that is going to be that level to keep in mind. A lot of area of supply and resistance for Google in and around those levels. And then finally coming over to Microsoft, a lot of consolidation for Microsoft as well. Support level inside this green area of rectangle area of demand at low 400s. Resistance all the way up to 431, 432 for Microsoft. PayPal, on the other hand, seeing a little bit of a pullback for the right reasons, as we discussed, that every stock, as it goes up, it needs to come down to take a bit of a breather, down over 3%. Support level is going to stay put down to $76, and this right here will turn back into a resistance for PayPal right now. And Visa also pushing back up a little bit, consolidating sideways for the most part, finding it very difficult to break out of this resistance at 275, 278 for Visa right now, and a lot of consolidation, and that next resistance is going to be back up to 282. Enphase really struggling, down over 5.5%, almost 6%, coming back down to that area of demand and support in the low 90s. And so that right there, after a lot of consolidation sideways, that's going to be that next support, that very, very strong area of demand to watch for Enphase. And that next resistance and target is going to be 124, 125 for Enphase moving forward. And then finally coming over to Costco, had a huge day yesterday, giving almost all of it back today, down over 1.7%. And again, consolidating sideways in that range with the support level sitting roughly at 872. So hope you all enjoyed this video and a complete update on the markets and of course the economy as well and the inflation numbers. Let me know your thoughts down in the comment section below. And of course, I will be live to cover the Tesla robotaxi event later today. So as always, happy investing. Make sure that you drop a like, subscribe to the channel. Links to our Discord and Patreon is going to be down below if you're interested in joining us. Happy investing. I'll see you.